Welcome back to the Deep Dive. Today, we're really cutting through the corporate speak, getting into the strategy behind the numbers for a consulting giant, Accenture.
Yep. Looking at their fiscal year 2025 results.
Exactly. And this isn't just, an earnings report. It feels more like a declaration, a big strategic pivot centered on generative AI.
Absolutely. A major shift.
So our mission today, let's dissect those performance indicators, see where the money's really flowing, both for growth and what they're trimming, and, crucially, figure out what that huge AI investment actually delivered. Okay, let's unpack this.
Right. And stepping back for just a second, the big picture financially,
Right.
FY25 was strong, no question. They met or beat all their original adjusted guidance.
Nailed it, basically.
Pretty much.
Okay.
Total revenues hit $69.7 billion. That's a solid 7% increase. And importantly, that 7% growth held up in both U.S. dollars and local currency, LC.
The LC number, always the truer measure, stripping out those currency swings.
Exactly. It shows the real operational health.
Okay, 7% growth. That consistency is good, shows resilience. But, in this tech environment, is 7% really enough to wow the market? Seems a bit steady.
Well, maybe think of it as the foundation, right? Not necessarily the explosive part. The bedrock is solid. Adjusted EPS, earnings per share, that came in at $12.93. That's up 8% over FY24.
Okay, so bottom line growth is there too.
Right. And it's this consistent financial strength that gave them the room, the latitude, to make these really aggressive multi-billion-dollar bets on AI.
Right, that's where the acceleration story kicks in.
That's where it gets interesting.
Okay, let's stick with the financials just a moment longer, this scorecard. Revenue, $69.7 billion, that's looking back. What about looking forward? New bookings tell that story.
Yeah, and for the full year, FY25 new bookings landed at $80.6 billion.
Which was actually, I noticed, a slight dip year over year, right? About 1% down in C and dollars.
It was, yeah, a minor dip.
Does that hint at maybe some clients hitting pause, thinking twice about huge commitments right now, even if the current revenue looks okay?
It's definitely something to watch. But, it didn't really derail their overall pipeline health. They kept a book-to-bill ratio of 1.2.
1.2. So for every dollar they billed.
They booked $1.20 in future work. That ratio, well, it's still showing demand is strong, outpacing what they're delivering right now.
Okay, that context helps. But I also saw the mix of those bookings change quite a bit, especially near the end of the year, Q4.
Right. Q4 bookings did pick up overall $21.3 billion, up 3% in LC.
And the type of work?
That Q4 rebound, yeah, it was really defined by the contract type. Managed services, the longer-term operational outsourcing deals.
The steadier stuff.
Exactly. That came in at $12.44 billion.
Yeah.
Significantly outweighed the consulting bookings, which were more like $8.87 billion.
So that shift towards managed services, that gives them that predictable revenue stream, doesn't it? Stability to fund the big bets.
That's precisely it. Stability lets you make aggressive moves elsewhere, like AI.
Good point. Okay, before we jump headfirst into AI, just quickly on the cash situation, they're clearly not short on cash flow or returning it to shareholders.
Oh, not at all. Free cash flow, FCF, was really strong. $10.9 billion for the year. That's a 26% jump year over year.
Wow, 26% increase.
Yeah, and their FCF to net income ratio was 1.4x. Very healthy. And they pushed $8.3 billion back to shareholders in FY25. Mostly share buybacks, but also $3.7 billion in dividends.
And they're signaling more of that coming, right? Straight away.
Yep. They announced a 10% hike to the quarterly dividend for Q1 FY26. It goes up to $1.63 per share. It's a clear sign of confidence, saying, yeah, we think we can keep this level of cash generation going.
Okay, confidence backed by cash. So the stable managed services deals, the strong cash flow, that all paved the way for the big Gen AI push, right?
Yeah.
Here's where it gets really interesting. They committed $3 billion over multiple years to this. So what did they actually get for that money in FY25? What are the results?
The results are, frankly, pretty dramatic. Exponential growth is the term that comes to mind. Gen AI bookings for the full year hit $5.9 billion.
Okay, $5.9 billion. And that's up how much?
Nearly double what they booked in Gen AI the year before, FY24.
Double bookings. Okay.
But the revenue figure, even more stark, Gen AI revenue for FY25 was $2.7 billion. That's a tripling of the revenue from FY24.
Whoa. Tripling revenue in just 1 year on a specific initiative like this, that's massive acceleration. That must be putting pressure on their competitors.
Immense pressure.
So what does that actually look like on the ground? Like, how many projects are we talking about? Is it a few huge ones or lots of smaller ones?
It's volume. In FY25 alone, They ran 6,000 Gen AI projects.
6,000.
6,000.
Yeah.
And just to give you some context on how fast that ramped up back at the start of FY23,
Yeah.
they basically said they had, quote, negligible projects in this space.
So negligible to 6,000 projects in, what, 2 years?
Roughly, yeah.
Yeah.
Scaling that fast, well, it demands a huge immediate shift in talent.
Which brings us to the people side. You can't just go out and hire, what, tens of thousands of Gen AI experts overnight. You have to build that capability internally, right?
Exactly right. They grew their pool of skilled AI and data professionals to about 77,000 in FY25. That's up from around 40,000 at the start of FY23.
Doubling their core AI data team.
Pretty much. And on top of that, they trained over 550,000 of their own people. 500,000 plus, just on the fundamentals of Gen AI.
500,000 people trained. They're essentially trying to rewire the whole firm's skill set in real time.
That's what it looks like. They have to.
You know, the most interesting strategic nugget I pulled from their materials wasn't just the size of the AI bookings, impressive as that is, it was the immediate knock-on effect.
You mean the significant data pull-through? Yeah, that's key.
Exactly. The finding that 1 out of every 2 Gen AI projects directly leads to a follow-on data project.
Right. It's the crucial long-term piece.
Because it shows AI isn't just magic, right? It doesn't replace the need for sorting out your underlying data. In fact, it makes having clean, modern data infrastructure more critical than ever.
Precisely. Clients are realizing, okay, we want this shiny Gen AI thing, but oops, our data's a mess.
Yeah.
So they need that foundational data work first or alongside.
Which totally validates that huge investment they made in hiring data scientists and training 500,000 staff on the basics. It feeds itself.
It really creates this virtuous cycle of consulting work, doesn't it? AI leads to data, better data enables more AI, and you also see them using it internally to get more efficient. They mentioned tools like AI Refinery, GenWizard, Synops.
Right, applying it to their own delivery, eating their own dog food, so to speak.
Demonstrates they're embedding it everywhere.
Okay, let's switch gears slightly. Let's look at the traditional slices of the pie. Where did all this growth actually land across the different business units and geographies?
Sure. So looking at the full year, FY25, growth in local currency. Managed services, as we mentioned, grew a bit faster at 9%. That brought it to $34.6 billion in revenue.
And consulting?
Consulting grew 5%, hitting $35.1 billion. So just slightly larger in total revenue, but managed services is definitely accelerating faster right now.
Okay. And geographically, they rejigged the regions, right? Latin America moved?
They did. Latin America joined North America to become the Americas market unit.
Yeah.
And under that new structure, the Americas really shone. 9% local currency growth, $35.1 billion revenue. Strongest region.
And the others?
EMEI followed that with 6% growth, about $24.6 billion revenue. Asia Pacific, which used to be called growth markets, posted 4% growth, hitting $10 billion.
Right. And what about industry groups? Where did clients spend most aggressively?
Okay, for the full year, products and financial services were the clear leaders. Products grew 8%, financial services grew 10% in local currency.
10% for financial services, that's strong.
Very strong. Health and public service and communications, media, and tech, they were both solid at 6% growth each. Resources was just behind at 5%.
But I noticed some real volatility if you zoom into just the last quarter, Q4. Financial services seem to really hit the accelerator at year-end.
Yeah, absolutely. Financial services jumped to 12% growth just in Q4. Huge acceleration.
While at the same time, health and public service actually went negative in Q4.
That's right. It was the only industry group with negative LC growth in Q4, down 3%.
That sharp split, what does that tell you? Maybe aggressive tech spending mandated in finance, driving that Gen AI revenue, maybe?
I think that's likely. Banks, insurance, they have to invest.
Well, maybe government and healthcare budgets saw some pullback or delays right at the end of the fiscal year.
It suggests that, yeah, selective client caution is definitely still out there, even with the overall success story. Spending isn't uniform across the board.
Okay. Now let's look beyond those traditional segments to their big strategic pillars. The established areas like security, cloud, Industry X. These aren't new, but they seem foundational to the AI push.
Oh, absolutely vital. They're the infrastructure, really.
Yeah.
Look at security. $10 billion in revenue for FY25, growing at a frankly blistering 16% in local currency.
16% on a $10 billion base is huge.
It is. But the really astonishing number is its history. Security has had a 35% compound annual growth rate, CAGR, all the way from FY16 to FY25.
35% growth compounded for nearly a decade.
No, it just tells you cybersecurity isn't a phase. It's this constant compounding business need.
And you absolutely need robust security and cloud before you can seriously deploy Gen AI at scale, right? They're prerequisites.
Exactly. Couldn't have said it better. Cloud delivered $39 billion in revenue, growing 12%. Industry X, their digital manufacturing arm, hit $9 billion with 10% growth. These pillars aren't separate things. They enable the successful Gen AI deployments. Even their newer focus area, capital projects, which they built up through 5 acquisitions, quadrupled its revenue from just $300 million back in FY22 to $1.2 billion in FY25.
Impressive build-out. And none of this happens in a vacuum. They lean heavily on their tech partners, don't they?
The ecosystem is completely essential. Over 60% of their total revenue involves projects with their top 10 partners.
60%.
Yeah, and that partner-driven revenue grew 9% in LC this past year. We're talking Microsoft, AWS, Google Cloud, Salesforce, SAP, Oracle, and significantly NVIDIA now.
NVIDIA, right. The AI hardware backbone. Makes sense.
Mm-hmm.
Okay, now let's flip to the other side of the coin. Optimization. You can't chase this kind of high-growth future without also trimming some fat, right? Cutting the dead weight.
That's exactly where that $865 million charge comes in. Most of it hit in Q4 FY25. They took a huge $615 million charge then for business optimization.
$615 million in one quarter. That's not just minor tweaks.
No, this was serious. It was tied mostly to severance costs and writing down the value of assets connected to divesting 2 acquisitions they'd previously made in the Americas.
Divesting acquisitions. Okay, that's a pretty sharp surgical cut. What does that signal? Are they getting ruthless about ditching legacy businesses, even profitable ones, if they don't fit the new AI, cloud, security focus?
I think it signals exactly that, a very focused, maybe even ruthless strategy. And there's more coming. They flagged another $250 million charge expected in Q1 of FY26.
Bringing the total near $900 million in just 6 months.
Right. And the whole point of this program, they say, is to streamline the workforce, find efficiencies, potentially roles that AI itself can automate or help with, and then immediately reinvest those savings back into the growth areas.
Like more talent upskilling, more acquisitions in the hot zones.
Exactly. Shifting resources aggressively.
Okay, so we've looked back at FY25, analyzed the current state with AI and optimization. So what does this all mean? Let's pivot to the outlook for FY26. What are they telling us?
Well, the FY26 guidance, it suggests maybe a more cautious take on the very top-line revenue growth compared to the last couple of supercharged years.
Okay, what's the range?
Revenue growth in local currency, they're projecting between 2% and 5%.
2 to 5%, that sounds like quite a slowdown from 7%.
It does, but there's a key nuance they pointed out. They estimate their U.S. federal business will be a drag, maybe taking off 1% to 1.5% from growth. So if you exclude that specific headwind, the underlying growth range is more like 3% to 6%.
Ah, okay. 3 to 6% ex-federal, that sounds a bit healthier. What about profitability for this leaner, AI-focused machine?
They're expecting slight margin expansion. Adjusted operating margin is guided to be between 15.7% and 15.9%.
So a small increase, 10 to 30 basis points over the adjusted FY25 number.
Modest expansion. And adjusted EPS, the bottom line per share, is projected between $13.52 and $13.90. That represents a pretty healthy 5% to 8% increase over FY25's adjusted EPS.
Okay, 5-8% EPS growth. And cash flow. Still strong.
Still looks very robust. The free cash flow outlook is pegged between $9.8 billion and $10.5 billion.
And that financial confidence, it flows right back to the shareholders again.
Absolutely. They explicitly plan to return at least $9.3 billion in cash to shareholders in FY26. That's another step up, a 12% increase year over year from FY25.
12% more cash back. Okay, so the financial stability is definitely there to keep funding the strategic shifts.
It seems so.
So pulling this all together, this deep dive, it really shows a company in the middle of a classic, pretty successful strategic repositioning, doesn't it? They held on to strong financial results in FY25 while just flooring the accelerator on Gen AI, tripling revenue, thousands of projects.
Yeah, maintaining consistency while driving radical change in one area.
And they're clearly committed to reinvesting the gains, training literally 500,000 staff, making acquisitions, but also making those tough optimization cuts. It shows they're willing to take some short-term financial pain, like those divestiture charges, to secure what they see as long-term market dominance in AI.
It really is textbook portfolio management, isn't it? Aggressively fund the future, strategically prune the past.
Exactly. Which brings us nicely to our final thought, something for you, the listener, to mull over. We heard that 1 out of every 2 GenAI projects pulls through a follow-on data project. What does that really tight correlation tell you about the absolute bedrock skills that big companies are going to need most critically over the next, say, 5 to 10 years?
Good question. Beyond just the AI experts themselves.
Right, and thinking about those optimization cuts, divesting those 2 acquisitions, which other historical service lines, things maybe not directly tied to AI, cloud, or data, perhaps older types of process optimization, basic IT support, which of those might be next on the chopping block for streamlining, or even divestiture as these powerful AI tools become more and more commonplace?
Yeah, where does the efficiency axe fall next? Something to definitely keep an eye on.